We all tend to judge a company by its profit, right? But that's really only part of the story. Today, we're going to look beyond the income statement to solve a really critical business mystery. What is a company's true financial health? So let's grab our detective hats and get started.
So let me ask you a question right off the bat. Imagine a company, it's reporting record profits quarter after quarter. Everything looks fantastic on the surface. But could that same super successful company suddenly just run out of money and fail? What do you think?
While the answer might surprise you, but it is a big, resounding yes. A profitable company can absolutely go bankrupt. And the culprit, the smoking gun in this whole mystery, is something called cash flow. You see, there's a saying in finance, profit is an opinion, but cash is a fact. And today, we're all about the facts.
So, here's our game plan to crack this case. First, we'll dig into the mystery and get our detective's toolkit ready. Then, we'll examine the three main places we'll find our clues. That's operating, investing, and financing activities. And finally, we'll learn how to piece it all together to read the company's full story.
Every good detective needs a toolkit, right? And for us, it's one of the most important documents a company makes, the statement of cash flows. Now, this statement follows a very specific set of rules, kind of like an official detective's manual, called International Accounting Standard 7, or IAS 7. This is going to be our guide for the whole investigation. So, what's the whole point of this document? Well, the standard itself puts it really simply. Its main goal is to show you exactly how a company's cash has changed over time. We're talking about tracking the actual money coming in and going out. No weird accounting tricks, just the cold, hard cash. And why should you care about this? Well, because this one statement is incredibly powerful. With it, you can figure out if a company can actually pay its bills, you can compare its real-world performance against its rivals, and you can even get some major clues about where it's headed in the future. It's huge.
All right, let's dive into the real detective work. Our first, and I'd say most important clue, comes from what we call operating activities. This is the part that tells us if the company's main business, what it actually does, is generating any cash.
And the official definition? It's actually super simple. Operating activities are just the main things a company does to make money. It's the cash flow from its day-to-day business. So for a coffee shop, it's selling coffee. For a car maker, it's selling cars. Simple as that.
So, this all boils down to the fundamentals. Cash coming in from customers and cash going out to pay for supplies, to pay employees, and of course, to pay taxes. Here's the key takeaway. If a company can't generate positive cash right here from its core business, that is a major red flag. I don't care what the profit number says.
Now, companies have two ways of showing this. There's the direct method, which is pretty straightforward. It literally shows cash in, cash out. But the one you'll see more often is the indirect method. It starts with that profit number and then makes a bunch of adjustments to work backward to the actual cash amount. It's a little less intuitive, but it's popular because it really highlights the difference between the profit they reported and the cash they actually have.
Okay, let's move on to our second clue and see how this builds the story. This is all about investing activities, and it tells us a ton about how a company is spending its money to grow and prepare for the future. So, what are we talking about here? Basically, it's about buying and selling long-term stuff, big ticket items. This isn't about the daily grind, it's about the big strategic moves. Is the company investing in new factories and technology, or is it selling off its assets just to stay afloat? Here are some classic examples. A company spending cash on a brand new factory? Well, that's cash going out, a negative cash flow. But it's usually a really good sign that they're expanding. On the flip side, if you see a company constantly getting cash from selling off its assets, that might mean it's in trouble and is desperate for cash. And that brings us to our final clue, financing activities. Okay, so we know if the business is making cash and how it's investing for the future, but now we need to know, how is it paying for all this stuff? This whole section is about the relationship between the company and its investors and lenders. The people with the money. It tracks where the capital is coming from to fund all those operations and investments we just talked about.
It's pretty logical. Taking out a bank loan or issuing new stock, that brings cash in. Paying back that loan, buying back shares, or paying dividends to your shareholders, that's cash going out. Looking at these flows tells you if the company is raising money, paying off its debts, or rewarding its owners.
Now hang on. Before we deliver the verdict on our company, there is one critical, golden rule we have to remember.
This is a direct quote from the accounting standard, and it is non-negotiable. If a deal doesn't involve actual cash changing hands, it does not belong on the statement, period.
For instance, let's say a company buys a new headquarters, but finances it entirely with a mortgage from the seller. Or it buys another company by just giving them new shares instead of cash. These are huge important events for sure, but since no actual cash moved, you won't see them here. They get disclosed somewhere else in the financial reports.
Okay, the moment of truth. We've gathered all the clues from operations, from investing, and from financing. Now it is time to put it all together and deliver the final verdict by reading the company's complete cash story.
You really do read it like a story, and the pattern tells you everything. Think about it. A healthy, growing startup might have positive cash from its operations, negative cash from investing because it's building new stuff, and maybe positive cash from financing as it raises money to fuel that growth. A big, stable company, on the other hand, might be using its huge operating cash flow to pay down debt and pay out dividends. These three sections tell a narrative that the profit number all by itself just can't.
So there you have it. You now have the toolkit. Go beyond that headline profit number. Find the statement of cash flows, because the next time you see a company announce record profits, you'll know to ask the real question. Okay, that's the opinion. Now show me the cash.